Trump just reinstated the blockade on Iran and slapped a 20% toll on every ship crossing the Strait of Hormuz. Oil ripped more than 10% Monday and closed at $83. Energy led the entire tape while chip stocks got smacked. And this morning is loaded. CPI hits 1 hour before the open, and the big banks all report before the bell. Today we cover what to know and where the action is right now. So let's break down exactly how this unfolded. On Monday, President Trump announced America is reinstating the Iranian blockade, with the United States as guardian of the strait. His words were, a toll at the rate of 20% on all cargo shipped for providing safety and security. Iran's military command answered within hours, warning of a forceful response. This waterway carries about a fifth of the world's oil, so every added shipping dollar lands in the price of crude, and crude flows into almost everything in your portfolio. And understand the mechanism, because this is not a blockade in the textbook sense. Ships can still cross. What changed is the price of crossing. Pay the toll, pay the war, risk premium, or sail the long way around and pay in time. Whichever door a shipper picks, the cost lands in the same place, the delivered price of a barrel. That is why a policy announcement in Washington shows up at your gas station before anything else happens on the water. Now the chart. This is Brent Crude daily. Friday closed at 75.22. Monday's session ripped straight through it and closed at 83.31, up more than 10% in one day. Look at the shape of that Monday bar. It opened above Friday's entire range and never gave the gap back. That is not day trader froth. That is a repricing. The market marked the fair value of a barrel up $8 in one session and held it into the close. That Friday close at 75.22 is now your first support. Overhead, the March war high sits near 120. That is the level this market panics toward, not trades to. As long as headlines keep coming out of the Gulf, dips are getting bought. And the tell that the premium is unwinding is just as simple. A daily close back inside Friday's range. Until you see that, the market is saying the blockade is real. If the weekend talks deliver, this war premium unwinds fast. Is the strait actually closed? Wrong question. The right question is, what it costs to move oil through it now. Maritime trackers counted only 5 vessels crossing over a day and a half last week. Before the war, roughly 130 transited every day. The U.S. military tells a different story, claiming more than 140 ships made it through over the last week. Pick either number. The direction is the same. Traffic has collapsed, and war risk insurance now runs 2 to 6% of a ship's value, millions of dollars per voyage, straight into the crude price. Here's the S&P 500 daily. Friday closed at 75.75. Monday closed at 75.15, down about 0.8%. That's it. A full weekend of war. And the index gave up less than 1%, which tells you the market is treating this as an oil story, not a growth story. Why so calm? Because the index level is the wrong lens for a day like this. Energy up 3% and chips down 3% nets out to almost nothing at the index level. The violence was all in the rotation underneath, and that is why your account and the index disagreed on Monday. The lines on this chart are your framework. Above, Friday's close at 75.75. Below, Monday's low at 75.06. Between those lines, everything is noise. If the index loses Monday's low with conviction, this becomes a different conversation. Until then, the tape is calm. Under the surface, the damage wasn't tech. The Nasdaq fell about 1.5% Monday, closing near 25,900. Pull up Nvidia, down about 3.5% to 203.53 after closing Friday near 211. If your portfolio is tech heavy, this is exactly why your account was red on a day the index barely moved. Now, why do chip stocks care about a waterway? Because an oil shock is an inflation shock, and inflation keeps the Fed careful. When the rate path moves, the longest duration growth names reprice fastest, and chips are carrying the biggest gains on the board, so that is where traders raise cash on a war headline. The map from here is simple. Friday's close near 211 is the level Nvidia has to reclaim to call Monday noise. Monday's close at 203.53 is the line it has to hold. Lose that with the rest of the tape risk off, and this stops being an oil story for tech. The other side of that rotation, energy. This is XLE, the energy sector fund. It closed Monday at 56.74, up 3% on the day, because $83 crude flows straight into producer earnings. Now drill one level deeper into the heavyweights inside that fund. Exxon closed Friday at 138.88. Monday, it ripped to 144.51, up 4%, and tagged 145 during the session. Chevron, same picture, 176.40 on Friday, 182.20 on Monday, up better than 3%. When both mega majors gap up and keep running into the close, that is not a short squeeze. That is money rotating in with intent. This is the classic wool premium rotation. Money leaves growth and crowds into the barrel, and it repeats every session. Hormuz stays hot. Just remember the flip side. These names are now priced for $83 crude. If the weekend talks land, the same elevator goes down. Gold, the war hedge that is not doing its job. It closed Monday right around 4,000, down from its January record near 5,600. With missiles in the air, gold fell again. The reason sits in the bond market. Here is the 10-year Treasury yield, daily. Friday, it closed at 4.56. Monday, with war headlines everywhere, it rose to 4.62. That is the tell. In the old playbook, war means you buy bonds and yields fall. This time yields went up because the market reads a Hormuz toll as an inflation problem before it is a safety story. And a yield north of 4.5% next to a firm dollar pays you to wait in bonds instead of holding a metal that pays you nothing. This year, the war premium went to oil, not gold. If gold is your hedge, Monday was the test, and the test failed. Step back. Why does one waterway price everything? Scale. About 20 million barrels of oil move through Hormuz every single day. That is a fifth of world consumption and more than a quarter of all seaborne oil, plus about a fifth of global LNG. There is no pipeline network that replaces it. Think of it as the busiest toll booth in the global economy, with no service road around it. The bypass routes that do exist are limited, and they are already in use. So when the cost of that choke point rises, there is no relief valve on the supply side. The price does not negotiate, it just moves. That is why one tanker strike shows up in your energy stocks, your airline tickets, and the inflation print the Fed is staring at. Now, the part the war headlines vary, the world is not short of oil. On Monday, OPEC cut its demand growth forecast for this year, citing a weaker China. And the International Energy Agency says global supply jumped by more than 4 million barrels a day in June. Translation, today's price is fear, not shortage. Fear premiums deflate fast. If Saturday's talks deliver anything real, this trade unwinds without sending you a warning. So how high can crude actually go? These are scenarios, not predictions, but they are what the big desks are positioned around, and every one of those lines is on this chart. Start where we are. Monday closed at 83.31. The first lineup is 100. That is Goldman Sachs' model. If the Strait stays mostly shut another month, Brent averaging above 100 with a third quarter path toward 120. From here, that is roughly a 20% move, and it is the level where crude stops being a finance story and starts being a headline story. The next line is 110, where government models of a one-quarter halt in Gulf exports land. Then 120, the March war high. This market has actually traded there this year, which is exactly why every desk anchors to it. 130 caps JP Morgan spike zone, 120 to 130 if disruption persists. And the top line, 150, is JP Morgan's overshoot case. That is not a target, that is a tail. Now notice what is not on this map. Not one of these desk models crude just sitting still at 83. Either the talks deliver and the war premium unwinds back toward the 70s, or the Strait stays hot and this grinds toward triple digits. That asymmetry is what your energy positions are actually pricing. None of it is a forecast. It is the map of what the market fears. Your calendar, and this morning, is loaded. 8:30, Eastern June CPI, 1 hour before the open. An oil shock walking into an inflation print. That is the whole morning in one sentence. Also before the bell, JP Morgan, Goldman Sachs, Bank of America, Wells Fargo, and Citigroup all report earnings. Here is JP Morgan, daily, the biggest tape of the morning. Friday, he closed at 336.47. Monday, 334.53, down about 0.5%. A full war weekend, and the biggest bank in America barely moved. The same calm red the index gave you. Consensus has JP Morgan earning around $5.50 a share, but the headline number matters less than what sits inside the report. Net interest income, because the rate picture just moved. Trading revenue, because a stretch that ends in an oil shock is usually good for a trading desk. And credit provisions, the line that tells you whether the banks see the consumer cracking. 5 banks report inside 2 hours. By the open, you will know whether Wall Street thinks this economy absorbs an oil shock. Saturday, the next round of U.S.-Iran talks in Oman. And the Fed meets on the 28th, with markets pricing about a 2 in 3 chance rate stay put. Inflation and bank earnings set this morning's tone. Any headline out of the Strait can reprice oil within minutes. That's the setup. A war premium in oil. A rotation hiding under a calm index, a hedge that isn't doing its job, and a morning that starts swinging before the bell. Quick recap so you walk in ready. Oil keeps its gap while Hormuz stays hot, and the unwind signal is a daily close back inside Friday's range. The index is calm, but the rotation underneath is violent. Energy is collecting the war premium, and tech is paying it. Gold failed the hedge test because yields rose instead of falling. The scenario map runs from 100 to 150, and not one desk on that map models Crude standing still. And this morning stacks an inflation print on top of 5 bank reports, all before the opening bell. No predictions, no positions, and none of this is financial advice. Just the numbers and the levels straight off the chart. If this saved you a morning of scrolling, subscribe. Let's crush it in the market today.